Small caps are the most misunderstood categories. They are very unique, and that's why many miss it. And I've discovered 9 such unique things, the USP of a small cap fund. Those 9 things I'm going to cover in this video, and these 9 things will open your eyes to know what kind of category is this and whether you should invest and how much you should invest. A very interesting video. Watch till the end. Hi, I am Franky Fernandes. I am the founder of Harmony and Money. It's a community to help young families to grow their wealth and also their relationship. I'm a certified financial planner and a marriage coach. My goal is to share concepts, tips to help families to work as a team so that they can grow their wealth and also build a strong bond. So to that end, I make my videos very simple, conceptual, so that you can understand and apply it immediately in your investing journey. So let's get into today's video. So before we learn those 9 unique things about small cap funds, let's first understand the underlying small cap shares. What are they? Stocks, small cap stocks. Let's understand what are the features of these small cap stocks. So basically the first 100 stocks in the index are large caps. Then we have the second layer, which is the mid caps, which are from 101 to 250 shares companies. And anything above 250 are small caps. Anything above 250, that is from 250 first company, they are considered as small caps. So the total small cap companies could be more than 5,000, but honestly speaking, only 500 to 800 companies are actually investable. Basically, these small cap stocks are young businesses and they are proving their business model. So they are actually small and they are testing the market whether they will grow. And these stocks have very less analyst coverage, and I'm going to talk about it a little later, a little more in detail. And these shares also have lower liquidity. You can't buy and sell like the large cap stocks. And in most cases, these are highly leveraged companies, which means they have taken a lot of loans because to grow their company as opposed to equities. So between FY19 to FY25, smaller companies delivered a profit of roughly 20% CAGR, compounded annualized growth rate, from 20 to 25% growth rate, whereas some of the other large companies could be 12 to 15%. So there's a huge margin between these companies. And what are small cap funds? Small cap funds, according to SEBI's definition, are funds where at least 65% of the portfolio must be invested in these small cap stocks, which is above 250. That is from 250 first, those companies have to be invested in the small cap funds. So now let's get into those very interesting 9 unique things about small caps. So let's go one by one. So number 1, which is the USP, the informational inefficiency advantage, unique to small caps. Now this is the single most powerful USP of a small cap stock, of small cap stocks, which are neither in the large caps and mid caps. So for a company like HDFC, Reliance, which are part of Nifty 50, you may have 30 to 50 analysts globally covering these companies. For mid caps, you may have 5 to 10 analysts, maybe 15 analysts. But for small caps, you may have 0 to 1 analyst. Not many cover. Analysts do not cover small caps. So what does this tell? So it creates a unique gap between the real price, the real business value, and the price. So often, because there is no analyst coverage, because there is no knowledge, except for speculation, what happens is these stocks are not really valued as much as they should. But the moment the analyst covers, understands, and then they start investing, and then everybody else comes to know, prices go up. Because the one who finds it out first, the analyst who finds out first, takes the lion's share. Let's take an example. So basically, it's like, buying, as an example, it's like buying a house in a well-known area. Everybody knows. So the prices are all set. But what about a house in some remote area and not many have the information that there will be, the government is going to develop that area, or there may be an airport coming up. Nobody knows. And if you know about it, if you to read newspapers and come to know about that this area may develop one day, what you do? You go and buy it. Nobody knows, only you know it. And what happens? You may have bought it for some 10 lakhs. And once everybody comes to know about it, and if there's an airport coming up, what happens? The 10 lakhs may become 10 crores. So let's take a real example of this unique thing about small cap. For example, Keynes Technology. Now, this is a company that manufactures PCBs, which are printed circuit boards, and electronic assemblies for aerospace, defense, and automotive. So, in 2021, it was a small company. Not many knew about it. But Nippon India's small cap fund manager actually studied this company and understood that India's PLI scheme for electronics would benefit this company. And this also was a strong, this company had a very superior technology of execution. And this fund manager bought these shares, and it gave 11 times returns in 3 years, 11x returns in 3 years. And that's where this small cap fund became the top in the category. So it is like Sachin Tendulkar, everybody knows when he was at the peak. But when he was 14 years old, when he was a teenager, only one coach identified him. So small cap stocks are like this. So there's an informational inefficiency. The more people come to know, the less the price increase. But if nobody knows, there'll be an opportunity for exponential returns. And that's what is unique with small cap stocks. So the USP number 2, the graduation story, the triple compounding through category jumps. Let me explain this. Now, this is exclusive to small caps. It cannot happen in a large cap and a mid cap. There are 3 things that happen in a small cap when it grows from a small company to a big company. When a fund manager identifies it as a small 1,000 crore company, that can become a 10,000 crore company. And how does a fund benefit from this? Number 1, earnings growth. Because smaller companies, the earnings are very high, 20, 25, even 30% CAGR. So what is happening? The company is expanding fast. Number 2, re-rating. Once fund managers are able to identify, that means investors identify these companies, they're willing to pay a higher price for the same profits because they see a potential. And number 3, index inclusion premium. Once the company keeps doing well, it becomes a part of the index. So it becomes a part of the small cap index, which means every index fund manager is forced to buy, and it gets visibility. So these are the 3 things which are unique, 3 things that happen in a small cap which are unique to small cap. And let's take an example. The best example I can think of is Titan Industries, one of the favorite stocks of late Rakesh Jhunjhunwala, where he made crores of rupees from this one stock. And how is it so? In 1984, Titan was a small company, a joint venture between Tata's and Tidco, a small watchmaking company in Hosur, Tamil Nadu. And it was a small cap. It was really a small cap company competing with HMT watches. And actually, Titan went through these 3 stages. Earnings growth, because revenues exploded because of Tanishq jewelry and fast track watches. So these actually made Titan explode in terms of earnings. Second, the PE re-rating. Investors were willing to pay premium for this share. And finally, it became a part of Nifty 50. A 1 lakh investment in 2003 would be roughly 1.5 to 2 crores today. A 150x to 200x returns in 20 plus years. This is the story of Titan, and this is the story of many small cap companies. So when a company is growing and investors start loving it and are willing to pay premium, that's the graduation story. And that is what is unique to small cap companies. So the USP number 3, M&A optionality, which is mergers and acquisitions optionality, a wild card unique to small caps. The small cap companies actually potentially are targets for big companies, their acquisition targets. Instead of doing something from scratch, big companies look for small companies. For example, Google acquired smaller companies like YouTube or some other analytics companies. Instead of building from scratch, big companies acquire these small companies, and that delivers 30 to 50x, and that can deliver a huge percentage profit. Now, large cap companies are never acquired, they're already huge. Mid caps might be, but small caps is a high probability for good companies to be acquired, and that delivers value for shareholders. Now, Zandu Pharmaceutical, which would which manufactured Zandu Balm, Zandu Chyawanprash, it was a small company. It was a 100-year-old Ayurvedic company. Now, nobody thought of this small company, a boring company, of that it can be acquired. Imami, the FMCG giant, which manufactures Fair and Handsome and Boroplus and some of the other well-known brands. In 2008, they gave they launched an open offer for Zandu at 7,315 per share. And at that time, Zandu was trading at around 2,000 per share. Just imagine 250% profits, premium delivered overnight for the holders of Zandu. Subsequently, Imami revised its open offer price for Zandu Pharmaceuticals from 7,315 to 16,500. That was the final offer. Now, this can happen for a small cap. USP number 4, niche sector exposure. And this is unavailable for large and mid cap companies. Let's look at the table here. Now, here, if you look at the table, the niche sectors, specialty chemicals, precision engineering, contract manufacturing, regional retail FMCG, defense components, and niche pharma. Now, if you look at large cap and mid caps, their exposure is limited or none. But if you look at small cap exposure, it is deep, primary, direct, exclusive, significant, and primary. Simply because these are small companies, these are niche sectors. And any of these sectors or companies in these sectors, if they do well, which happens, then the value that it releases is huge. For example, Vinati Organics. So Vinati Organics manufactures two extremely niche industrial chemicals. One is ATBS, which is used in water treatment and oil field chemicals globally, and IBB, which is used in pharmaceutical companies, pharmaceutical intermediaries. Now, these are not household names. The end users are globally. End user companies are global. And the competition is limited because it's a chemical hard to replicate. In 2010, Vinati Organics was a small company, 200 to 300 crore market cap. So no large cap company, no large cap mutual fund managers ever could consider this. It was a small company and it was never in their radar. Vinati Organics became the world's largest manufacturer of ATBS, 65% market share. And by 2024, 25, the market cap crossed 20,000 crores, a 60 times to 80 times journey. Now, mutual funds that identified Vinati Organics made huge gains for their shareholders, for the unit holders. And a large cap company, Nifty 50 based large cap companies, completely missed Vinati Organics. So that was USP 4. Now, USP 5. Fund selection demands a very specialized skill by fund managers. Now, let's take a look at this table here. This table has fund selection factor, large cap, mid cap, and small cap. Now, if you look at index versus active decision, index mostly win. 85% of the times they win over a longer period compared to the active funds. Mid caps, active has an edge, definitely. But small cap, active significantly outperforms index. Fund manager, how important is a fund manager? For index funds, large cap, you don't really need huge fund manager skills. For mid caps, moderate, but for small caps, it's critical. It's the biggest differentiator. A good fund manager delivers great returns, who identifies opportunities. Now, AUM sensitivity, large caps, low, mid caps, it's moderate, but if the AUM increases for a small cap, it's disastrous. You cannot have a huge AUM. because you're buying illiquid. You will be forced to buy illiquid stocks. And what about track record needed? You need 5 years, sufficient track records. 5 years is enough. In mid caps, probably 7 years. But for small caps, you need around 10 years track record to really know if it's a great fund or great fund manager. Now, number of good funds. Large cap, there are many funds. Mid cap, there are several good funds. But small cap, just few genuinely good funds. So selection is importance. Selection is extremely important. Selection of the right funds. Now let's take an example of this. The fund manager matters. Now let's take an example of how a fund manager matters. How a fund manager is the alpha differentiator. Nippon India small cap on one hand and an average small cap fund on the other hand. Just imagine two investors. One purchased Nippon India small cap, the other purchased another fund. And they both did SIP of 10,000 rupees from between 2015 to 2025. Nippon India gave around 20 to 22% CAGR in 10 years, whereas the other funds gave 16 to 17% CAGR. And what is the difference? The average funds gave around 38 to 42 lakhs, whereas Nippon India gave 52 to 58 lakh rupees. See the difference. Around 10 to 16 lakhs difference purely because of fund manager skills. Now, this does not happen in large caps and mid caps. And a disclaimer here, I'm not recommending this fund. Please talk to your financial advisor or mutual fund distributor before purchasing this fund. These are the past returns. Future, we do not know. This is only used as an example. Now, USP 6. Investing behavior demands are uniquely extreme for small cap funds. Now, if you look at this table here, it shows the behavior challenge. Max drawdown tolerance. Large cap 35%, mid cap 50, small cap 75, which means your portfolio drops by that much. That's called drawdown. See the difference. An SIP break-even horizon. Now, this is very unique. For a large cap, 5 to 7 years, mid cap, 8 to 10 years. For small caps, it is 12 years based on data. That means you have to wait for 12 years at times when you do an SIP with on small caps. Now, lump sum danger of at peak, which means when you invest at peak and the market falls and then again goes back, like what happened just now during, the US-Iran war. What if you had invested in November, December at its peak? The markets have fallen 5, 10, 15%. The markets have fallen, crashed from those levels. For example, the large cap funds have fallen by around 11% from its peak. So usually it recovers faster in large caps and even mid caps, but it is extreme. It takes 3+ years sometimes to recover. And temptation to exit during crash. You don't really feel the urge to exit in a large cap because it doesn't fall so much. Lesser in maybe slightly more in a mid cap, but when you see a small cap funds fall by 15, 20, 30, 40%, there's a strong urge to leave and abandon small cap funds. Now, return variability year to year. The variability which happens, the volatility is low, moderate, but it's extreme, can swing from 80% to minus 50% in 2 years. That is the investing behavior demands. That is the investing behavior demands in a small cap. USP 7, behavioral stress test, the psychological crucible. Now, this is the most underrated risk in small cap investing. See, the normal large caps or even mid caps tests investors' patience. But this is the category which really breaks investors' psychology in such a way that destroys wealth. For every other category like large cap or mid cap, it's mostly the market risk. But here there is market risk plus investor psychology plus the behavioral risk. And research consistently shows that this behavioral risk has destroyed far more wealth than actually the market risk. Every investor who holds small caps through all the cycles actually makes wealth. But there are those who come out during the crash because they cannot take it. They lose far more wealth than any other category of investor. So it's such a delicate two-layered risk, which is only unique to small caps. Let's take this hypothetical story here, a case study where Between 2018 and 2021, SIP investments were made by two investors. One investor, let's name the investor Ravi, who was actually doing an SIP, Ravi and Priya. And Ravi watched the NAV fall by 50% by March 2020. Panicked, paused SIPs in October 2018. And when he saw the crash in 2020, he stopped, or he redeemed and came out at a 45% loss. And Priya had made a commitment. I will not stop my SIPs for 12 years. She continued the SIPs and, in fact, increased her SIPs during the crash by 5,000 rupees. By by December 2021, Ravi had permanently lost 45% of his wealth, of his small cap investments. But Priya, on the other hand, made 55 to 65% gains by continuing SIPs. And you see here the twofold risk, the market risk and the behavioral risk. And the behavioral risk is often the bigger risk. The market was same for both of them. Absolutely same. It crashed 50%. It went up, maybe crashed a few times, went up, but Priya came out successful. Ravi lost. It is nothing else but behavioral psychology, the risk tolerance. Now, USP 8, redemption risk is shared. This is the invisible threat. If you want to redeem a large cap fund, you can redeem even 25-50 lakhs and it won't affect the NAV, because when you sign up for or when you redeem, the fund manager can sell large cap stocks very easily because they're very liquid. And when they sell, there's no price difference. It doesn't matter much. But if you were to redeem 25-50 lakh from a small cap fund, that puts a pressure on the fund manager, because the fund manager has to sell a big portion of the AUM to give you that redemption money. And then when they have to sell, a lot of the small cap stocks are not so liquid like large cap funds or large cap stocks. So what happens? There's a distress sale that happens. The fund manager has to sell small cap stocks, especially during the downturn. Such huge redemptions comes during a crash, during the downturn. So the fund manager is forced to sell at a less price, at a distressed price, plus he has to face illiquidity. So this compounds. And what happens? It affects the other holders in the fund. Because of a few investors' redemption, because the number is large, it affects the existing NAV, existing fund holders. Now, this is unique only to small cap. So your redemption can affect your fellow investor or you yourself if you already have substantial amount still in the fund. So this is unique only to small cap companies or small cap funds. And finally, USP 9, financial goal alignment. Let's take a look at this table here. The financial goals, small cap suitability, and why. So if you want to buy a home in the next 3 to 5 years, 7 years, you cannot invest in a small cap fund. Emergency fund, absolutely no. Wedding or short-term goals, no. Retirement 5 to 10 years away, no small caps. Small caps is only, for example, your child's education 15 years away. Then you can think of a small cap. Retirement 20, 25 years later, small cap is suitable. Wealth creation with no suitable goal, you just want to create wealth in the next about 12 years, then small caps. Because in 5 to 10 years, the market can crash and it may take a number of years to recover. So you cannot have 5 to 10 years. It has to be beyond 10, 12 years. Only then a financial goal, which is about 12 years, 15 years makes sense. Now, this is very unique to small cap funds. So number 1, informational inefficiency. Number 2, graduation story, those 3x compounding. Number 3, M&A optionality. Number 4, niche sector access. Number 5, fund manager matters most here. Number 6, investor behavior demands are uniquely extreme. Number 7, behavioral stress test. Number 8, redemption risk is shared. And number 9, goal specificity. Now, these 9 are unique to small caps. You won't find this in mid caps and large caps. Now, because they are unique, obviously, not any and every investor can invest for any period of time. Absolutely no. You need a separate set of investors, separate set of qualities, risk profiles to invest. Now, what kind of investors, for what horizon, how to choose the right funds, etc., cannot be done in this video. If you're really interested, let me know in the comments that you want another video where I can explain who should invest. The goal and purpose of this video was to show you how unique is small caps, and that's why it is risky. It carries high risk, and we have seen in these 9 points, right? I hope there is some learning in this video. Let me know in the comments whether you liked it or didn't like it, and why you liked it or didn't like it. And if you want another video where I can explain much more on small caps, please do let me know. And thank you for staying till the end. If you are not a subscriber to this channel, I strongly recommend that you subscribe. This channel is for young families who want to grow their wealth and also their relationship. So until my next video, bye for now.